Hello, everybody. John Jamieson here again. Hey, listen, I'm really excited to shoot this quick video with you today. Usually you see my smiling face in front of a board or something like that, but today I just need two slides to illustrate the power of interest, and actually, more importantly than that, is how interest is calculated. See, most people think they understand interest, but in fact, not 2 out of 100 really do. Because 5% is not 5%, is not 5%, and it's not 5%. There's all kinds of different ways to calculate interest, and the way that interest is calculated determines whether or not that interest is working for you or working against you. Now, the most common term you always hear is average rate of return, and it might be something like this. I sit down with you as a financial advisor, and let's just say that I say, look, I can average you a 25% rate of return over the next 4 years if you give me $100,000 today. And in your mind, you're thinking, wow, 25% rate of return, that's fantastic. Assuming I could, of course, it seems too good to be true. It probably is. But let's assume I could talk you into it, and you give me your $100,000, all right? And I promised you a 25% average rate of return over the next 4 years, and I'm going to take your money and put it into the market, okay? So let's show you this. Hang on one second. Okay, so let's take your $100,000. We put it into the market. 1 year later, your money doubles. You get not 25%, you get 100% return on your money after 1 year. You caught the market at a really big upswing, and you doubled your money, and everything's great. You're really happy with me. You're excited. You're referring people to me, all that good stuff. All right. But the next year, market does what it does, and it comes back down. It comes back down just 50%. Now, see, it had to go up 100% to get to 200, but it only has to come down 50% to get to 100,000. All right, so now we're into year 2, but don't worry, because now in year 3, market doubles again, goes right back up. All right, now you got your $200,000 back, everything's great. But in the 4th year, market does what it does, and you lose 50% again in the 4th year. Now remember, we had a 4-year agreement. So you come into my office, and I give you your $100,000 back. Now, by the way, in reality, would you get $100,000 back? No way. First of all, I didn't do all this for free. I took money out of it for sure. You also have time value of money and inflation, so your $100,000 certainly isn't worth what it was 4 years ago. Okay, and it's a debacle what just happened to you, and yet I did exactly what I said I was going to do. Remember, I said I would average you a 25% rate of return. Now, in your mind, you thought, well, that's 25% compounding rate of return. No, I said 25% average rate of return. And if you add the 100% gains, subtract out the 50% losses, and divide that by 4 years, which was our agreement, I averaged you a 25% rate of return on your money. So the next time someone says they're going to average you a certain rate, understand that averages can be manipulated. So as an example, if I was trying to put you into some mutual fund, just as an example, and I didn't like the 5-year average to show you, it didn't look good, but the 7-year average or the 10-year average looked fantastic. What average am I going to show you? See, I can pretty much take any average I want to show you to bolster my case that you should give me your money. All right. Now, so that's average rate of return. There's also simple interest. So let's talk about this. You're getting a taste of average rate of return. I want to give you another example here in a minute on another slide. You also have simple interest. So when you're paying simple interest, let's take the same $100,000, and let's say I loan you the money for a year, and at the end of the year, you haven't paid me anything back, but it's time to make an interest payment, and I'm charging you 5% interest. Well, you owe $5,000 interest on the money. If you pay me that, right, and I don't need my money back, you can keep the $100,000 for next year, but I'm going to need another $5,000. It's 5% simple interest. So the loan isn't going backwards at all, and it's also not increasing because I'm at least paying the interest portion. So that's average interest. Okay. No, I'm sorry. Yeah, that's excuse me. Looking at too much average. That's simple annual interest, what I just described to you. Okay. There's also amortized interest. Now, amortized interest, you're very familiar with, because that's what most of us are familiar with. When we borrow mortgages, when we borrow car loans, when we borrow any kind of money for a set period of time, it's almost always amortized interest. So I borrow $300,000 for my house, at 5% interest, amortized over 30 years. And so now when I start making payments at the beginning of that loan, it's very high interest. Okay, most of my payment is going towards interest in those early years for many, many years. And a little bit is going towards principal. And that principal is buying down the mortgage a little bit over time, which means every year a little bit less goes interest, a little bit more goes to principal. But that is amortized. And if I send extra to that loan to the bank, it doesn't affect my payment. So if my payment was $2,000 a month, my payment's still going to be $2,000, even if I send an extra $10,000 to the principal. I still have to pay $2,000 a month with an amortized loan, but now more of that $2,000 is going towards principal and less towards interest because I sent that extra $20,000. But it makes you very hesitant to send extra money because you're basically giving up access to all that money and it's locked up inside that loan. Okay? So you got simple interest, you got average daily balance, average daily balance is what we're going to talk about now. So average daily balance interest goes something like this. This is what your credit cards and revolving lines of credit, this is how their interest is calculated. So it goes something like this. I have a credit card. At the beginning of the month, I had $5,000 I owed on it. That was probably the first 2 weeks. Then all of a sudden I had another charge and I owe $7,000 at the end of the month. Now I didn't owe $7,000 all month, so they can't charge me interest based on the entire $7,000. They're going to come up with an average daily balance. In other words, on the average for that month, how much did I owe them? And they're going to put an interest rate associated with that. So you have amortized interest, simple interest, average daily balance interest, and average rate of return interest. Okay? Now let's go back to the average rate of return. You see how I just averaged you a 25% rate of return and yet you didn't make any money. Please write this down. Average rate of return is not compounding of money. Average rate of return is not compounding of money. So let me give you I think it's a better example than this one. As powerful as this one is, I have another one for you. Okay. Now this one here is pretty interesting. This is all about average rate of return as well. And it matters when you have your gains and when you have your losses for the average. So very quickly, here's what this says. It says we both start off, there's two columns there. Let's say you're one column and I'm the other column. We both start off with a $500,000 nest egg. We're going to pull 5% of that out to live on every year. And we're going to factor in a 3% inflation rate. And we're going to assume both accounts average 8.43% rate of return over 20 years, which would be pretty nice. Over 20 years, that's a really solid rate of return. So, of course, that sounds good to most people. But remember, this is an average, and averages are figured by taking the total time that we're going to look at it, which is basically over 20 years, right? And every year, I either made an interest rate or lost an interest rate on the money. And then at the end, we're going to average that out. So let's say this first column is you, and you started off with $500,000 with everything we talked about, and you're pulling out money every year, and there's a rate of inflation factored in. But the first year, you timed it really well. You were in the market, and the market went up 32%. Fantastic, okay? Now, me in this column, I didn't time it so well. I went in at a different time, and I caught it on the downslope, and the market went down 37%. Now, during both of these years, remember, we both still took out 5% of the principal balance. So you were able to take out a lot more. I took out a lot less, all right? Next year, you lost 3%. I gained 5%, but I gained 5% of a much lesser number. All right, so when you look at these rates of return, 32, -3, 30, 8, 10, 1, all we did here, folks, is we flipped when that money was made, not the amounts, but the percentage is when it was made. So if you go down here, we just flipped them. So this year was 32% gain, minus 3%, 30% gain, 8%, 10. It's an exact match for up here. We just flipped it. But see, the difference was, since we had the great timing of this average rate of return, we were up at well over $630,000 when we started taking out our money. Down here, we were barely at $300,000 when we started taking out our money. So assuming we continue this for 20 years, at the end of 20 years, you've taken out all of that money and you still have $1.5 million left in that account. That's pretty good. Now over here, same rate of return, same starting amount, again, same average rate of return, but look what happened. I started going heavy down at the beginning. I could never catch up. So even in years when I had a 29% rate of return, it was on a much less smaller pool of money. Okay? So all of a sudden, we get down to year 20, and I've been broke for 2 years and really broke for about 3 years, not much in 4 years. My money's gone, and it has been gone. Meanwhile, you prospered. So what does this mean? It means that when you're going to pull money out of some kind of a retirement account, and you're going to turn that into a pension plan, which is really what you're doing here, right? You're basically annuitizing this. The place to have your money when you're doing something like that, at least for some of it, is not to be in the open market. Because if you happen to have to take money out, the same time you're getting battered with market losses, you can see it just absolutely devastates a retirement account. So maybe we want to use, could be a fixed indexed annuity, a no-fee fixed indexed annuity. Put the $500,000 in there. When the market goes up, it will receive gains. When the market goes down, though, you don't lose any money. And now you're drawing out your money with never having to take money out during a down year. And that money is going to last you substantially longer, especially if we put some kind of lifetime income rider on it. Okay? So I'm not a huge fan of mutual funds to grow wealth, but I'm an absolute opponent when it comes to taking money out and being in the time of your life when you're going to start withdrawing money and leading a certain lifestyle based on that money. Okay, so ideally, when you borrow money, if you can, try to borrow simple interest, meaning you just have to pay the interest back. You can let the principal float, or you can pay the principal back anytime you want to. All right. Now, when we're getting credited interest, we would like to be credited compound interest, but also not lose any money. So if we can get compounded interest up when the market goes up, but none of the downs, which you can in the no-fee fixed indexed annuity, people are doing it every day across this country. You just might not be aware of it. A lot of annuities are given a bad rap, and frankly, some of them deserve the bad rap. If they have high fees, if they're variable annuities where you can lose a lot of money inside of them and get charged high fees, it's not what we're talking about, folks. There's really solid fixed indexed annuities where your principal's protected. You have a chance at really nice gains, but none of the losses, and you can withdraw money for the rest of your days. And if you look at this example, you see how critical that can become. If you're trying to time the market as you're withdrawing money, it can be absolutely devastating. So we hope this little video really shine the light on interest and average daily balance. By the way, another thing you want to do is when your money's sitting around, you would like it to be earning interest of some kind or canceling out interest. See, folks, when you owe money on a revolving line of credit, when you put money into that line of credit, when you pay down on it, because it's a revolving line of credit, you can access the cash again. So instead of letting your money sit in your checking account for 3 or 4 weeks before you pay all the bills and leave a little bit left in your checking, why not use a line of credit, do something positive with the line of credit, whether it be invest in something or pay down amortized debt or something productive, but then treat that line of credit almost like a checking account and let your cash flow sit inside there until you're going to do something with it. See, guys, when you set up your life that either your money is always earning you interest when you have control of it, or it's canceling out interest on money that you owe others, that is the way to systematically, automatically grow and protect wealth. So I want to thank you for stopping by today. Check out some of our websites. I've got a really nice presentation on investment grade life insurance that will pay. It'll pay you compounded interest tax free, but when you borrow money out of the policy, you pay simple interest. So you might want to check it out just for that. So go to perpetualinsurance.com, perpetualinsurance.com. Check that out. And then we've got many more videos here. So make sure you register for the YouTube channel. Check out some of our other videos, and we'll keep them coming. All right. Thanks for stopping by today. We'll talk to you soon. This has been John Jamieson. Bye-bye now.